Hello fellow traders. Today we'll embark on a journey into the exciting world of stock options. Options can seem a little complex at first glance, but fear not. We'll break them down to easy to understand concepts, and by the end of this video you'll be equipped with the basics of options trading and ready to explore this powerful financial tool. Today we'll get into Options, a beginner's guide by Pajama Trader. Stock options, a bet on the future. Think of options contracts as with built-in expiration dates. These contracts essentially allow you to make a prediction about a stock's future price movement. Options offer leverage, meaning you can control a larger number of shares with a smaller upfront investment compared to buying the stock outright. The leverage can lead to amplified profits, but also magnified losses. Understanding options contracts, predicting stock price movements, leveraging your investment potential with options contracts. Options offer the right but not the obligation to buy or sell a stock at a specific price by a certain date. Imagine if you have a strong hunch about a stock's future price movement. Options allows you to place a strategic bet on that hunch with the potential to magnify your gains. Calls and puts, two sides of the same coin. Calls and puts cater to opposing market outlooks. Calls are for investors who believe the stock price will rise in value. Puts are for those who expect the stock price will fall. With calls, you're hoping to exercise the option to buy the stock at a lower price than the market price. With puts, you're expecting to sell the stock price at a higher price than the market price before expiration date. Calls and puts, catering to opposite market views. Calls, ideal for bullish investors. Puts, favored by bearish investors. There are two primary types of options, calls and puts. Calls grant the right but not the obligation to buy the stock at a certain price, the strike price, by a certain time, the expiration date. They are ideal for investors who believe the stock price will rise in value, bullish. Puts grant the right but not the obligation to sell the stock at a certain price, the stock price, by a certain time, the expiration date. They favor investors by expecting the stock price to fall, bearish. Calls and puts cater to opposing market outlooks. Calls are for investors who believe the stock price will rise in value. Puts are for those who expect the stock price will fall. With calls, they're hoping to exercise the option to buy the stock at a lower price than the market price. But with puts, they're expecting to sell the stock at a higher price than the market price before expiration. Key option terminology. Let's unpack some key terms you'll encounter frequently in options trading. The strike price is the predetermined price point at which you can exercise the option to buy or sell the stock. The expiration date is the critical deadline to act. If you don't exercise the option before it expires, the contract becomes worthless. The premium is the price you pay to own the option contract, similar to a non-refundable deposit. Intrinsic value applies only to stocks that are already in the money, meaning the strike price is favorable compared to the current market price. Check out the Greeks video attached to this video to know more about theta and delta. Understanding options jargon. Understanding key concepts. Grasp these terms to navigate the world of options trading effectively. Strike price, predetermined price at which you can buy a call or sell the put, the stock if you exercise the option. Exercise date, the deadline by which you must exercise the option or it becomes worthless. Premium, the upfront price that you pay for the options contract. Think of it as an entrance fee for your options play. Intrinsic value, The difference between the strike price and the current market price of the stock for in-the-money options only. Option payouts can be a bit tricky, but they boil down to this: how the stock price performs relative to the strike price by expiration. Calls are profitable when the stock price rises above the strike price. You pay to exercise the option to buy the call or the stock at a lower price. Puts are profitable when the stock price falls below the strike price. You pay to exercise the option to sell the stock at a higher price. Remember, options contracts expire, so timing of your predictions matter. The profit or loss you make on an option depends on the difference between the strike price, the premium paid, and the stock price at expiration. Calls typically generate profits when the stock price surges above the strike price by expiration. Puts typically generate profits when the stock price falls below the strike price by expiration. Option strategies for beginners. We've uncovered the basics. Now let's delve into some beginner-friendly option strategies. Covered calls and cash-secured puts are a more conservative strategy that allows you to earn income on options while potentially mitigating downside risk. Covered calls are ideal for stocks you already own and believe will stay flat or rise slightly. Cash-secured puts are your friends when you're okay with potentially owning the stock at a discount if the price falls. The caveat for these kinds of strategies is if you plan to day trade it, you'll need $25,000 in your account, or you'd be subject to the pattern day trading rule, the PDT. Covered calls involve selling a call option while already owning the underlying stock, ideal for generating income on a stagnant or slightly increasing stock prices. Cash-secured puts, similar to covered calls, but you sell a put option instead. This strategy benefits from the decrease in stock price or flat movement. Risk and considerations in options trading. Options trading is a powerful tool, but wield it with caution. Options can lose their value entirely by expiration if not exercised strategically. Remember, options magnify not just profits but also losses. There can also be additional fees and commissions associated with options trading compared to buying stocks directly. Always prioritize in-depth research and starting off with a small account before risking any real capital. And start smart to build your options knowledge and comfort level. Options trading carries inherent risk and requires solid understanding of market dynamics. Here are some key points to consider. Options can expire worthless, resulting in a complete loss of premium paid. Options magnify gains and losses compared to buying stocks directly. And options trading involves additional fees and commissions. Additional resources for learning. This video is a springboard for your options trading journey. Here are some excellent resources to further explore and deepen your understanding in options trading. The SEC website provides investor education resources. Investopedia offers in-depth options tutorials. And Khan Economy has free online courses. Or even watching videos in this channel. A quick pit stop. There are several companies I've identified for significant moves next week, and I am looking forward to sharing their charts and analysis with you. They are Novavax, ticker symbol NVAX, and Marathon Digital, ticker symbol MARA. Charting of Novavax, ticker symbol NVAX. This surged on positive news last week, or at the time of this video. This has an average volume of 37.7 million. It had a high volume of 29 million, pushing it to 815. It sold off with about 178 million in the $11 area. With steady average volume, this can get to the 11 area or better. but if the volume falls less than the average, this could fall and correct around 850. Charting of Marathon Digital, ticker symbol MARA. Cuban's been saying that things are messing up crypto. Let's see how the miners react to this news. The average volume is about 28 million, and at the 26 area, this had 84 million in volume to get there. This sold off with at the 27 area with 213 million in volume. This could recover at 13 if the volume falls below the average. But if the volume spikes up to the average or more, this could get to 29 or better. Conclusion: options, a strategic tool for active investors. Now, we've explored the fundamentals of options trading. As a final takeaway, remember, options can be a strategic tool for active investors. They provide a unique set of capabilities to go beyond buying and selling stocks. They generate income on stock holdings. With covered calls, you can collect premium while potentially profiting from a modest stock price increase. They also hedge against stock positions you own. Options allow you to create protective puts to hedge against potential downturns in stocks you already own. They also profit from volatile markets. Options offer a potential to magnify gains in volatile markets, but remember, they also magnify losses. Options trading requires a strong understanding of the financial markets and carries inherent risk. However, when used strategically, options can be a powerful tool to enhance your investment returns. Options trading can be a valuable tool for active investors seeking to generate income on stock holdings, hedge against stock positions, and profit from volatile markets. Thank you for joining us on this presentation on stock options. I encourage you to conduct further research, explore the resources provided, and start with a small account or paper trading to build your options knowledge and confidence before venturing into the live market. If you found value in this video, give it a like and share this video with other traders looking to change their trading game. Consider subscribing for more Market Edge videos and market alerts. Thanks again for watching.